Refinancing a personal loan involves buying out your current loan with a new one. Essentially, you apply for a new loan, either with the same lender or a third party, and use the funds to pay off your existing personal loan. Then, you make payments on your new loan at your new interest rate. Generally, borrowers refinance loans to get a lower interest rate or to extend their loan term. Extending your repayment period can lower your monthly payments, but it typically means paying more interest over the life of the loan. With a good credit score, you can refinance anytime, but it's most beneficial if you can save a dollar or two in the process. While each of us have different reasons for wanting to refinance a personal loan, it is important to understand the benefits and potential downsides. Now, what are the benefits? Refinancing gives you a chance to qualify for a lower interest rate, which can lower your repayment amount. And if you can afford larger monthly payments, a shorter loan term will reduce the amount of paid interest. If you're in a bind and need financial relief, a longer repayment term can lower your monthly bill. But what are the downsides? If you opt for a shorter loan term, your monthly bill will go up, even though you'll save more money over the long term. Borrowers who opt for longer repayment terms usually pay more interest over time. And since refinancing involves taking out a new loan, you may find yourself on the hook for new loan origination fees, which is a one-time payment made upfront to the lender. Some lenders also charge payment penalties for closing out your loan earlier than planned. This is known as a prepayment penalty and is a one-time fee that will vary amongst lenders. Lastly, refinancing involves applying for a new loan, which can generate a hard credit check that temporarily lowers your credit score. But don't worry, your credit score will only drop a few points and will recover within a few months. Now that we covered the nitty-gritty details, here's what you actually need to do to refinance your personal loan. Step 1. Figure out how much you need. Before applying for any loan, it's important to know how much you need. You can check your lender's online portal or recent statements to determine how much you owe before you start shopping around for a new personal loan. Step 2. Review your credit score. Most lenders advertise their best rates. Unfortunately, you're unlikely to qualify for these rates with a low credit score or a negative mark on your credit report. To make sure you don't run into any nasty surprises, it's a good idea to check your credit score before applying for a new loan. You can also request a free copy of your credit report at annualcreditreport.com to check for any discrepancies. Step 3. Compare lenders and rates. After you calculate how much you need and review your credit score, it's finally time to start shopping for a new loan. Generally, online lenders offer the lowest rates. And obviously, we all want the lowest interest rate, but make sure you read the fine print to double check there aren't any hidden fees. Step 4. Pre-qualify online if possible. Most lenders let you pre-qualify for a personal loan with a soft credit check. This process doesn't affect your credit score and allows lenders to show you your potential loan size, terms, and interest rate. Step 5. Finally apply for a new loan. Once you've found a lender that meets your needs, the next step is submitting an application. You may have to provide several identifying and supporting documents in the process, such as your government-issued ID, social security number, pay stubs, or tax documents. Step 6. Use your new personal loan to pay off the old loan. Once you receive your new loan, you can use the money to pay off your existing debt. Thanks to technology, most lenders now offer direct-to-lender payments for refinancing and debt consolidation loans. Other lenders may deposit the money into your account, which you can then use to repay your loan yourself. Whatever the process entails, the most important part is that you actually pay off your old loan. Step 7. Make sure your old loan is closed. After you've repaid your old loan, double-check that it is officially closed. Miscommunication and mistakes happen all the time, especially when a lender is working with thousands of customers. Double-checking also protects you from surprise fees or penalties, so take the time and make sure the old loan is closed. Step 8. Start making monthly payments. Finally, it's time to start making your monthly payments. To make sure you never miss a payment, we recommend setting up automatic, recurring payments straight from your bank account to the lender. Refinancing your personal loan can save you a hefty chunk of change over time. But before dashing into it willy-nilly, it's important to do your research and ensure you're making the savviest financial moves you can. Whether you should refinance and with which lender depends on your financial situation and reason for refinancing. Always be sure to weigh the pros and cons carefully, and don't forget to compare fees and penalties before selecting a new lender. Now, if you like this video, then make sure to hit that like button, subscribe, And join us every week as we break down personal finance topics in plain English. See you next week.